My name is Patrick Boyle and I'm a finance professor at two of the top UK universities, teaching the derivatives class to Masters in Finance students. Welcome to my YouTube channel. In today's video, we're going to learn about our first derivative, futures. Take a look at my other videos to learn about other derivatives like options, swaps, credit derivatives, and all the rest. I'm creating these videos from my book, Trading and Pricing Financial Derivatives, which is available on Amazon.com. I've provided a link in the description below. Okay, so our first question, what is a future? A futures contract is a standardized financial contract obligating the buyer to purchase an asset and the seller to sell an asset at a predetermined future date and price. Futures contracts specify in detail the quality and quantity of the underlying asset. The contracts are standardized to facilitate trading on a futures exchange. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. The price at which the transaction will take place is known as the futures price or the strike price. The delivery and the payment occur at a specified future date, known as the delivery date. The contracts are negotiated at the futures exchange, which acts as an intermediary between the two parties. The party agreeing to buy the underlying asset in the future, the buyer of the contract, is said to be long, and the party agreeing to sell the asset in the future, or the seller of the contract, is said to be short. The idea of a futures contract is quite a simple one, and so obviously they've been around for quite a long time. The first futures exchange market was the Dojima Rice Exchange in Japan in the 1730s, which was built to meet the needs of samurai who, being paid in rice after a series of bad harvests, needed a stable way of monetizing their pay. The Chicago Board of Trade listed the first ever standardized exchange-traded forward contracts in 1864, which were called futures contracts. This contract was based on grain and started a trend that saw contracts created on a number of different commodities, as well as a number of futures exchanges set up in countries around the world. Because of this agricultural background in the derivatives market, it's no surprise that in the United States, Chicago is the center of the derivatives marketplace. As mentioned in the last video, futures are legal contracts between two counterparties. Futures contracts are highly standardized. They usually specify the underlying asset or instrument. This could be anything from commodities to currencies to financial securities. The type of settlement, either cash settlement usually or physical settlement. The amount and units of the underlying asset per contract. The currency in which the futures contract is quoted. The grade of the deliverable. This is usually extremely specific. For example, a wheat futures contract will specify the variety of wheat, its quality, and even the protein content of the wheat. It'll also specify the last trading time and date, and the delivery date and location for the delivery of the underlying product. Details such as the tick size, which is the minimum permissible price fluctuation. So that's all for this video. If you found it useful, please hit the like button. Please subscribe if you'd like to see more videos like this. Equally, comment below if there's something you'd like me to cover in my videos. Do check out some of my other videos explaining how futures pay off, how margin works, and how we calculate the fair value of a futures contract. Bye, and thanks for watching.